Why'd you do that?
Not that kind of volume.
All right, so let's talk about volume. Volume is the amount of shares that are traded between buyers and sellers at any given time. And so if you're on a 5-minute time frame, then during that 5 minutes, this amount of volume traded, right? If you want to skip ahead at any point, go ahead and just click on the chapters down below. Time is measured on the x-axis and price is measured on the y-axis. So if you're looking at your chart, it lines up with the candlestick directly underneath it at the bottom of the chart. Now, depending on what time frame you are, it'll tell you how much volume was traded. So if you're looking at 6 5-minute candlesticks versus one 30-minute candlestick, they're gonna have the same exact volume. If you're in a trading community, you'll see a lot of there's no volume today. Today seems like a low volume day. Look at all this volume rushing in. Wow, look at how much volume there is. If there's no volume, then essentially there's no market participation. Basically means that the market isn't convinced on this trade. This trade isn't ready for the market to partake in it. Another way to think of volume is like conviction. Little volume, then that means little conviction. A lot of people don't believe in what's happening in terms of price. So the way that I look at volume is I use it to gauge whether or not a move is real. So for example, if you're seeing like a bull flag, right, where a bull flag is just a massive flag pull followed by some small retracement with some consolidation with decreasing volume, right? So the decreasing volume after a big massive move is a hint that there's a potential for an additional move, right, for a continuation. When you see the move kind of happening where candlesticks start to break out a little bit, if there's no volume, that means there's no conviction. That means that people aren't convinced that this trade is going to go. But if you see price break through that resistance and break out and a bunch of volume starts rushing into the trade, then you know that a lot of the people in the market believe that this is going to be a good trade. And so they're going to rush into the trade, pushing it up, making it go higher, making other people go in, right? So it's kind of a self-fulfilling prophecy. On the other hand, if you see that maybe a stock is sitting right at its resistance level and it looks like it wants to break out and it puts in a big candle, but there's no volume, it can easily pull back underneath that resistance, trap a bunch of bulls up there, and now you're holding a bag. So if you're bullish or you want the price to go up, then what you want to see is increasing volume on a breakout or decreasing volume on a retracement. So when a stock is pulling back, you want to see that no, there's not a lot of people pulling this stock back. When a stock is breaking through that resistance and going higher, you want to see that the market is participating. You want to see a bunch of people jumping into the trade. You want to see that there's a high conviction in this move. Same thing to the downside. If you're buying puts and you want to see a bear flag breakout, then you want to see that it breaks down through the support level with a bunch of volume pouring in. And if it does retrace back up, not that much volume pouring in, right? So volume has to be on your side. So if you're bullish, you want to see a lot of volume coming into the play as the price is going up, but you don't want to see too much volume coming into the play as the price is pulling back. And on the flip side, if you're bearish, then you want to see a lot of volume come in as the price moves down and not so much volume come in as the price comes back up. So let's talk about breakouts. You'll see on a real breakout that a bunch of volume will kind of step into the trade, and then you'll get 4, 5, 6 candlesticks that are all just a bullish move, right? For example, towards the end of the move, you get a crazy amount of volume on a crazy candlestick. And then typically right after that, it'll kind of slow down or reverse. That big move with that big candlestick with all that volume is called exhaustion. Exhaustion typically comes at the end of a move. For example, think about it like this. Let's say that everybody was watching Apple today and Apple formed a bull flag on the 5-minute. And when it broke through, some people didn't get it immediately, but some people jumped in as soon as it broke through. They saw that a bunch of volume stepped in. Other people jumped in, making the volume come up, making the price come up. Other people FOMO'd in, and more people FOMO'd in. And on that very last candlestick, the absolute last amount of people who were interested in buying bought it. All the rest of the market who missed it, they all bought it up there, right? And now there's no more buyers. All the buying power is exhausted. There's no more buyers in the trade. So naturally what happens is it comes down, right? If there's no more demand and all this supply, then it's going to come down. So typically when you see a big candlestick at the end of a move with a bunch of volume, it's probably not the best time to get in because that move is probably already done. I did exhaustion, I did the breakout. Now you mentioned volume stuck with time along the x-axis, but we haven't talked about volume stuck with price along the y-axis. Volume shows are essentially volume traded at a specific price. So if Apple traded between 930 and 940, traded between 100,000 shares, you'll see that on the x-axis. But if Apple traded between 175.20 and 175.30 in those 5 minutes, then you'll see that on the y-axis. Volume shows are really important because they can show you where potential support and resistance levels are. So if you see a very large extended shelf, then you know that that's a level where it might either hold price up or keep price down. One of my favorite things to use volume profile for is playing the gaps. When you see gaps between two shelves, or basically where there's no volume traded within those two shelves, it's like an empty row with no traffic. If there's no traffic ahead of me, I'm zooming through it, right? Price does the same thing. So when you see something break out with volume on the x-axis, through a volume shelf, through a resistance, you can basically buy it at the breakout of one volume shelf and play it till price reaches the next volume shelf. You can find volume profiles on trading software such as TrendSpider, TradingView, Thinkorswim, or Webull. What else have I not touched on? Alright, so we have a gift for you. Here at Gold Rush, we use what's called the Ultimate Volume Study, which basically tells you how much buying pressure and selling pressure there is in every particular candlestick, right? Not only that, but it tells you how much of the 30-day average is today's trading. I use this a lot in my trades. I use it for just an added piece of conviction, one little extra piece of confluence for me to build my case and say, you know what, this is a good trade. So this study for Thinkorswim is available for you for free. All you got to do is click the link in the description box. And if you enjoyed this video, then go ahead and click the next video on your screen where I show you my #1 indicator on how I find breakout stocks every single time. Peace.